What if I told you you could get a Tesla solar system and the batteries for free? Don't believe me, do you? Well, I'm going to show you in this video how you can actually go through and do that using other people's money and saving yourself a boatload of taxes using crypto, whether that's HEX here or liquidity providing, to actually be able to add the value to your property for free. It's hard to grasp, I know. It sounds like one of those infomercials that tells you you're going to get rich quick. That's not going to happen. But what can happen is you can get the solar system for free. It adds to the value of your property. We're going to touch on how all this plays out. We're going to touch on depreciation. We're going to touch on business. We're going to touch on the cost of the system and actually run through a specific example. What is the loan involved? How much does the loan cost versus the utility bill? All of the details associated with this so that you get to see all the information, and then how you can actually pay for it using other people's money so that you don't have to pay the bill. So, with that being said, if this is your first time here, what's good? My name is Sam, and for those of you who are returning, it is good to freaking see you. If you want to support the channel, there's a link down below, or there's several links down below to support the channel or check out other social and whatnot. Active on Twitter, on Instagram, my other YouTube channel, and probably one or two other things down below, maybe TikTok as well. So jump down below if you want to support that, or shop.letstalkpeds for some really cool stuff. Now let's get into the video. This is exactly what I'm doing for myself. The numbers are, I'll tell you exactly which numbers are accurate, which ones are made up in here, and then I'll keep maybe updating this video if you guys find value in it. But I want to caveat this with, I am not your accountant, nor am I your lawyer, so you should talk to both of those people if this is something you want to do, or do your own effing research, right? There's a thing called the internet, and you get to actually find all this information for free. So you should do that if this is curious to you. If you want to make more money, if you want to save in terms of your taxes, because if you look at an income statement, that is actually where we're going to begin, and you making more money. Because if you look at this from a W-2 standpoint, we have to understand the sequence at which cash flow comes in. W-2, you earn wages, then you pay taxes, and then you pay your expenses, right? You get a check and then you pay your expenses. With a business, you get sales, revenue, then you pay expenses, then you pay taxes. And you're like, well, taxes and expenses are flip-flopped between the W-2 example and the business example. Why does that matter? It seems like such a small change. Well, effectively what that allows you to do, if you own a business, is control expenses, which means that you can pay as little or as much as you want in taxes. That's how the formula works. It's not complex. And one of the ways to do that is with the solar system that we're about to get into. Now, for context here, this is going to be relating to, this is possible with W-2, but you know, just very quickly, 30 seconds here, if this is a personal residence that you bought for yourself and you're living in it with you and your family, the numbers could change. or if you want to, you could put your property in, leave the debt the way it is, put your property into an LLC, rent, set up a bank account, rent, lease your property from your business back to yourself at market rates, and then treat it as a business with all associated expenses. And then you can look at these numbers the same way I'm looking at them. If you're looking at them as a W-2 person, meaning you work, go to a job type thing, then you'd have to kind of go through that sequence of events I just stated. And remember, like, I'm not your doctor, I'm not your lawyer or your accountant. Where am I at? So this is exactly how I do this, right? This office here is actually rented to one of my businesses. And the real estate business owns this duplex that rents out. So when you look at what I'm currently paying for utilities, I pay $300 for electric. And that might, like, it's because we're going to touch on this in a moment. This $300 is probably high for some people's bills around the country, but there's virtually no insulation in my attic. And I live in Florida, and if you're not familiar with Florida, it gets pretty freaking hot down here, which I love. Don't get me wrong, I do love, but there is no insulation. So remember that point, because it's going to come up again towards the third deck that we get into. So what I'm going to do is put on solar. Let's do a pen here so we get some drawing action. Definitely leave a thumbs up for my drawing ability here. So I'm going to add in solar system, a new roof, battery storage, so that, like, I'm off the grid and it kind of works as a generator down here in Florida. It can also reduce your bill from the standpoint that most utility company providers have a peak pricing model. What does that mean, Tam? It means that, say, between 3 p.m. and, say, 7 p.m., the rate you pay per kilowatt for your electricity in your house is at a higher rate, because there's a lot of people coming home from work and flipping on their AC, or just starting laundry, or doing whatever it might be, just using more electricity across the board. So they charge a higher rate. There's a peaker plants that may have to be turned on, which are just super costly to do. So there's reasons behind this too, as an incentive to decrease usage, but also that could be more expensive during those times for actual reasons, not just trying to be gouging, right? And I'm going to put all of these into my property. Now, remember, it's a business. So in order to understand the full picture here, we're going to be super detailed. So you might want to watch this twice, or you might want to watch this twice with a piece of paper, because we're going to go over a lot of stuff. Assume, so this $300 is accurate. It's give or take about $300. Sometimes it's over $300. Sometimes it's a little less than $300. I'd probably say the number, on average, if I took like summer and winter, you don't really have winter, so to speak, where you get snow and stuff here, but slightly cooler months in January, February, and March, it's probably on average just over $300 or just about $300. Now, hypothetically, this is just an estimate, right? This is and I'm being conservative here because I've gotten one quote from a company that is 50% less than this, but it doesn't have the roof or the insulation on there. So insulation maybe $2,000, roof 12, 16 grand or something like that. So in either case, I think that $100,000 for the cost of the system is conservative. Keep that in mind, because the cost on the monthly payment, which we're going to get to over here, is actually going to be less. More than likely, it's going to be substantially less. When you operate a business, you can remember that formula, right? Income, your sales, your revenue minus your expenses. One of the expenses that you take for a business is one it's called depreciation. Depreciation isn't a real expense. So it's hard for a lot of people to grasp, but it is a fake expense that the IRS allows you to write off, right? Like if they allowed you to create other additional fake expenses, I would never, ever, ever pay taxes, and taxes would be a lot easier to try to figure out because I would just make up fake fucking expenses. That is not the case because we want to abide by the law, right? To avoid taxes as much as legally possible. And this depreciation fake expense allows us to take this cost and depreciate it over 20 years. So if you do the math on that, that's about $5,000 a year. So we spend 100 grand, right, to get all this jazz over here. We get to expense $5,000 per year if you're at the 30%. This is just an effective tax rate, right? Because in Florida we don't have state taxes. That's one of the reasons I moved here. So just assume that somebody has a 30% federal and state combined effective marginal tax rate. And you have to run the numbers for yourself for whatever your appropriate, tax rate is. That would yield $1,500 in savings. So what does that mean? What the say I'm talking about here? Okay, for business, right? I can put this shit on my house and I save, not including the utility bill, not including the decrease in cost, right? Not any of that. Just the depreciation used against the income of my businesses, and I can talk about the structure of how my businesses will be structured after I do this to capitalize on the massive tax benefits here. Well, very large tax benefits. $1,500. So I save $1,500. What is that? Not $300 a month. I mean, sorry, not $200 even a month. It's about $130 a month, roughly, maybe, if I do the math. Let's see, 1,500 divided by 12, $125 a month. Okay, so $125 a month is saving. So you're like, okay, cool, this is dope. If my payment over here is it's $425 a month, and I'm saving $125 a month from this in taxes, then the net effect would be the same, right, between these two numbers. $300 for the utility company versus $400 for the loan payment. Now, that would be correct. However, the rules are different for solar currently. I think it may have been the Jobs Act or some piece of legislation that was put in place in 2017 under Trump, thank you, that the depreciation for a renewable energy, or solar in this case, you get a 26% tax credit. So what does that mean? Well, a tax credit is different than an expense, right? Like this would be considered an expense here, depreciation expense. Depreciation expense lowers taxable income. Like, let me show you a little example here. Say you have $100,000, you're taxed at 30%. You have $30,000 you're going to pay in taxes. Now, let's assume that you have, say, $26,000 in expenses, right? So we're going to take $100,000 that is taxable. That's your profit in your business. We're going to subtract out $26,000 of expenses. You have a taxable income of $74,000 times 0.3. So you're going to pay $22,000 in taxes. $22,000 in taxes when you wrote off $26,000. Now, tax credit, same scenario there. $100,000 profit, but let's assume that we have a $26,000 tax credit. So, what does that mean? You don't subtract it from the taxable income like you do with depreciation. So remember when we said $100,000 times 0.3, you're going to pay $30,000 in taxes. Well, because it's a tax credit, you subtract it from the actual taxes. So you go from a tax bill of $30,000 down to $22,000 if you have $26,000 in expenses, and then if you have a tax credit, it's all the way down to $4,000. So like a 5x decrease in tax, more than a 5x decrease in taxes relative to just the expenses. So tax credits are super valuable. Like that's just cash in your freaking pocket. My friends, send me your cash. If you don't want to do this shit, you should help hire me. I'll fucking help consult you with this stuff. So how is this different under this rule or piece of legislation in 2017? Well, you get the $26,000 tax credit, but it doesn't stop there. They also say in the rules that you can depreciate the entire system in year one. So remember over here, the system cost was $100,000. Useful life is 20 years. That was an expense, $5,000 a year at a 30% tax rate. Boom, that's the actual amount you will see an increase in cash balance. That's yours, right? In terms of tax savings. Well, in this case, because of this rule, you're able to actually expense this entire amount. This is another quick example. Okay. $100,000 minus $74,000 equals 26 times 0.3. So the 26 is your taxable income, right, times 0.3, which is your your effective tax rate. Excuse me. You would be paying $7,800 in taxes. So think about this for comparative or contrasting. $7,800 in taxes versus $30,000, excluding the tax credit. Right? So then you're like, wait a second, I got a tax credit, but I only owe $7,800. Well, there's something called a tax loss carry forward, but we can cover that in a separate video. But basically, you're not going to lose this. You can just use the benefit the following year. But it gets even better. I sound like an infomercial, which you just keep adding on different pieces. Wait until you see the next couple slides. In the rules, for whatever reason, they allow you to add back 50% of the value of the tax credit. Why? I have no idea. I just want to be ethical and legal with how I do my business. This is what the rules tell me I can do. What does that mean? That means that your depreciable base, this is that expense that you can take in year one because of the jobs or the 2017 legislation. I can take an $87,000 tax or expense in year one. We're in 2022. I can write off $87,000 in year one. And you're like, whoa, this is some crazy shit, right? It's even crazier. This is the infomercial of me. I get a loan for $100,000, right? And they have subsidized interest rates. So say I'm paying 2%. I've already checked this out. It's probably 0 to 2%, maybe 3%. And I just chose 2%. But it's 0.99, so basically 1%, 2%, or 3% were very common rates. I chose the 2% rate here, but if I chose a 3% rate, this number right here would just be slightly off. Okay, if you put the numbers into an amortization calculator, that would give you a payment of a little bit less than $425 per month I would be paying. So you're like, oh, an increase in my payments, but on the after tax basis, it changes. Well, let's take a look at the loan a little bit more, because how the loan is going to work gets even better. So we're going to talk about the loan, but first we're going to talk about the tax savings. So what is the actual amount, right? We said over here, You get 74 plus 13 equals 87, plus we get this, right? So let's come over here. This is crazy shit, guys. This is insane. Year one, that would be this year, right? Tax savings, the credit here, the expense for the system. So this is the $87,000 times 0.3. So this is $26,000. So this $26,100 you can think of as the same as a tax credit. It's like a 1-for-1 offset rate. Basically, this is just going to be more cash in your pocket. HEX stake. What is that? 1,500. Well, we're going to get to that in a moment, but I just wanted to point it out here. When you add up all of these, the total tax benefit, this is taxes you don't have to pay. So if you're making $250,000 a year and you're paying $53,000 a year in federal taxes, one system can eliminate your tax bill for you, which means $53,000 in your pocket, right? What would you do with another $4,300 a month? What would you do if you had another $4,300 a month? $4,466.66. What would you do with that? $4,500 a month. Maybe you'd invest it? I don't know. But we're not going to even go down that path because then it gets way too complex and you lose way too many people. So we're going to talk about the loan, and then we're going to talk about how you can pay this. How you can pay this using other people's money, which means you don't actually have to pay for it. You go like the debt in this house they're living. I pay the bill as in I log into the mortgage servicing company and I press pay bill, or it sends it up automatically, so it automatically pays the bill from my account. But who actually pays the bill? The tenants pay the bill, right? I am a tenant here, right? Because I'm renting my office for myself. But let's talk about how this loan, right? The loan for these suckers gets paid by somebody else. But before we get into that specific piece, we got to touch on some of the differences here. So we already talked about how these are basically about the same on an after-tax basis, assuming the numbers over here are, I would actually probably be still beneficial. But what has happened by shifting from a utility bill to a loan payment? You're like, well, I pay $125 more per month. Well, if you thought that, that would be an accurate statement, but there's more to it than that. On the one hand, you have an expense. Remember, this is a business, right? So you have a $300 expense. This is going to reduce your taxable income by $300. Cool. Now you have a $425 going out. Notice how I said it was going out, and I did not call it an expense. Because what is this $425 made up of? Well, approximately $3,100 is going to be going towards your principal to pay off your house. That's $250 a month that's going back into your pocket. That's not going back into my pocket. It is. Think bigger. Macro picture. You have your house value, say it's $100,000, and you have a loan on it for, say, $90,000. Every single month, you're paying down your loan by $250 every month, right? For an aggregate of over $3,000 a year. So you go from $90,000 loan at the beginning of the year to an $87,000 loan at the end of the year. Now at the end of the year, you sell your property. Who gets that $3,000? My friend, that goes in your pocket. That is called equity pay down. Because also, the other portion of this is interest. What do we know about interest? Well, because this is for business, you can write that shit off. So you have another $2,000 expense at a 30% marginal tax rate, that's $600 of additional savings that could be added in over here in year 2, right? Because I say year 2 because we're going to have to talk about that in just a moment when we get down to the second half of this. But what, from a very heady standpoint, what does a loan allow you to do? Well, if you're familiar with this, HEX, what does HEX allow you to do? HEX allows you to capture the inflation in a system, right? You take your HEX, you stake it out into the future, and the system inflates, and only stakers actually receive any of the inflation. What happens in this case? Well, if you look up your state, utility companies are monopolies, and they are regulated, but they're allowed to raise prices every year. Generally speaking, it's between, say, 2% and maybe 5 or 6%. So we'll just call it 3%, 3.5%. So every year, your utility bill is going up by 3.5% per year, right? That goes against your, if you're working a W-2 job, it goes against your 3.5% increase in your wages, right, to offset that. So you are not earning inflation in this system when you're paying $300 a month. Who's earning the inflation? Here in Florida, Duke Energy. That's the company. They earn the inflation. Now, what happens when you have a loan? Well, there's one big benefit of a loan is that a loan is very good when there's high inflation. What do we know about the incompetence of decision makers in government right now? That they're incentivizing giant inflation. So that's not more of a tangent, right? But debt is good when inflation is high, is how you can think about that. Another thing is that you have solar, you have batteries, a new roof, and insulation. And we're going to remember how I said, remember insulation? I'm almost to that point. Almost there. But we're going to tie it in and loop back to that point in just on the next slide. When you're paying the bill every month, $425, that premium, that bill, right, because it's 300 versus 425, can be thought of as a premium to hedge against inflation, which allows you to earn inflation. You get to earn inflation. Another way to think about this is if you own a house and you have a mortgage, say in the example of a $100,000 house and $90,000 mortgage, what if your house value doubled, right? Now your house is worth $200K. Well, what if your debt doubled, right? Your debt went from $90K to $180K, right? Your debt just goes up lockstep with your house. You don't want that, right? Because then you're not capturing that. Well, with this debt, you're able to capture this because it's fixed, right? Because the other one was just an example to show you where the utility company is actually capturing it. In this case, you're hedging inflation. Next year, rates go up by 3.5%. Cool. It doesn't matter, bro. I'm chilling. I got solar. And I got these crazy tax benefits. Well, even better, this loan may be able to be structured so that I don't have any payments for 12 to 16 months. I'm laughing. I'm laughing because this is so idiotic. How can I put solar and batteries and a new roof and insulation on my property where I don't have to pay for it for 12 months, I don't have anything coming out of my pocket, and I get all these tax benefits, and I increase the value of my property, and I get $5,000 check in my pocket to do it? What? Yes. Yes, I'm already talking to companies where I can structure it where I don't have to pay a bill for 12 to 16 months, and I actually get paid cash. Obviously, it's just from a loan, which is perfectly fine for me, because that $5,000 is actually what's going to allow us to never actually pay the bill. I'm going to explain that in a second. Because you could take that $5,000 and do something with it, like make a HEX stake or yield provide. Now, before we get into the HEX stake and the yield providing, I want to actually talk about net metering. Florida has net metering. What does that mean? Well, I'm going to have solar on my property, and if there's excess energy generated that I don't use, that can be sold back to Duke Energy, right? Now, and I think it's it's a little bit more complex. Like I sell it back at retail prices, right? So I sell it back at the same price I purchased it at, and then if you finish the whole entire year with like a negative balance, basically the company owes you money, then at the end of the year you get a credit, and that credit is at wholesale prices. Like basically you're being a utility company to the utility company. So you're providing energy to the utility company, and that's how they justify selling it back to you at wholesale prices. So net metering, meaning I could actually generate a profit by putting solar on my house. How? How could I do that? Well, remember how I said that I didn't have any insulation in my property, and the bill was around $300 a month? Well, what happens if you add insulation? Well, there's less escape of the AC through the attic, right? And that's one of the biggest places to lose energy. So I can go through and insulate the F out of the attic, reducing the bill. Now, one of the things well, I'm glad this is towards the end of the video. You guys should press the like button as soon as you hear this. Okay, so in the rules, they state that in Florida, you're only allowed to put in a system that will generate how much you actually use. So they look at your utility bill. So given that this is something that I'm going to be doing in, say, maybe 60 days, and that I'm paying attention to this, what might be something that I would do? Well, I might run a little bit more AC so that my bill is higher, right? Maybe do things like that so that I'm able to put on a little bit larger of a system. And when you stack that with the energy savings from insulation, you have a potentially slightly larger system with a more energy efficient house, so that every month I could potentially be receiving cash flow. I won't get the cash flow to the end of the year, but you can think about this in a macro sense. I'll get cash flow every single month, which could effectively pay a portion of this bill, right? Say it's $29 a month. Cool, what do you freaking do? That bill goes down. It just helps out the entire equation, my friends. This is stupid. This is stupid. It's like somebody's like, hey bro, do you want $1,000? You're like, do I have to pay you back? He's like, no. You're like, is it like a loan? He's like, no. Well, do I have to do anything for it? He's like, no. And you're like, would I get it today, or is it like some point in the future? Today. Well, what's the catch? And he's like, well, it's actually $1,200. What? It's insane. And we haven't even got to the best part. We've just been having the steak. The whole dinner we have to finish. And let's talk about this, right? So this is the HEX steak. So if you take $5,100 and you put it into the HEX calculator for 1 year, and I'm gonna try to stretch these terms on this loan. I'm gonna see if they'll give it to me for 16 months. If they'll give it to me for 16 months, then this is actually greater than that, right? If I can get them to, give me more, that would be 4 additional months here times $425, or what is that? 1,700 bucks, $1,700. So that would be $6,800, $6,800. So these numbers would increase, and they would also be staked out into the future longer. Now, this number here, you're like, okay, cool. I had 5,100, now I have 5,500, but you didn't factor in Ethereum fees. I did factor in Ethereum fees. I actually took off $100 off the top to pay for the fees on the entry and on the exit. Right? And currently, at this moment in time, in June, fees on Ethereum are low, right? They're very low. Well, sub 10 bucks, easy, sub 10 bucks, most of the points during the day. So this would yield you about 97,000 HEX. When you look at HEX price, it is actually less than 6 cents. Less than 6 cents for HEX price. So what do you think HEX price might potentially be in, let's say, a year from today, right? Let's say a year from today, HEX price, instead of being 6 cents, was, say, 18 cents. Well, you now have $17,500. If you divide that by 4.425, which is your bill, you have just paid your electric bill for the next 41 months. And you're like, well, you said you could get it for free. Well, I'm not done. Stop interrupting me and I'll finish. So what could you do at this point? Well, you could shave off 1 year or 6 months. I would probably do 1 year of payments. Right? So say that's, you have $17,500, you're going to subtract $5,100, right? So you have $12,400. You take $12,400 and you stake that out for 1 year again, right? And now whatever that number is, 87, say 80,000 tokens. Well, I didn't do the math in year 2, right? But say HEX in 2 years from today is 36 cents. $28,000, and you rinse and repeat. Now, you're like, HEX doesn't always go up. Yes, this is true. So we were currently at around a 90% dip. What if HEX went to 3 cents? Well, then that's where the risk potentially comes in, right? So say in a year from today, when the bill comes due, HEX is at 3 cents. So times that, so you're left with $2,900, right? So at this point, if HEX was at 3 cents in 1 year from today, 2024 in June, 2023 in June, then you've got, let's see, divide this by 4.5, you've got the next 7 months without a utility bill. So basically you get all of these benefits, the tax benefits, all of this stuff here, which we didn't talk about taking the tax benefits and actually investing those. So like if you're like, well, you said you could get it for free. Well, I didn't do the math in this video because I've already been talking for a long time, but how you do this absolutely for free, take your tax benefits and invest them into the future. Use HEX or LP. We're going to talk about LP in a second. And LP is probably the option I'm going to actually go with. Right? So if HEX was 3 cents, but HEX could easily be, 56 cents. If HEX was, say, 50 cents, you're at 48 grand, bruh. Right? You could almost pay off your system. You can take 2 years out of this, right? $10,200. Now you have 2 years of payments set in a separate account that automatically pays your loan bill for you. You're left with $38,000 so you could stake out for 2 years. And in 2 years, maybe you got enough to pay your frickin' bill off and your house off. Another option, and just to remember, 425 could actually be less, Because if we're getting 29 bucks a month, as we mentioned earlier, maybe we get 30 bucks a month, maybe it's 12, maybe it's 67. I don't know what it will be. But whatever it comes out to be, I'm personally incentivized to try to get the system bigger, and then as soon as it's done, make the house even more energy efficient than it currently is, with adding additional insulation to the property. So, liquidity providing. Let's talk about that. This is another way you can do this absolutely free, and to do this, I'm going to use Uniswap calculator for liquidity providing. If you don't know what liquidity providing is, I would click on the link that has, or the face, my face with the hat on and the gray jacket for the channel. Go to search and look for liquidity providing. I've done several videos about that, especially if you think impermanent loss means that you actually lose money. Now, what is this? This is a calculator for Uniswap V3 pair between USDC and ETH at the 0.05%. What does that mean? That means you're putting up about 2,500 bucks of Ethereum and $2,500 of USDC into that pool at this fee rate, right? 0.05%. So that means that when somebody swaps from Ethereum to USDC, or when somebody swaps from USDC to Ethereum, they're charged 0.05%, and you're earning the fee, right? There's slight semantics behind that, but you're basically earning the entire fee. Not quite, but basically the entire fee. Now, this is a calculator that's based upon the volume, the trading volume between USDC and ETH, and they calculate how much you're actually going to earn on a monthly basis. Now, I'm currently providing liquidity, and I can say that this calculator has been relatively accurate for myself. Now, let's put in $5 grand, right? Because we got 5,100 bucks. We're going to say $100 worth of fees, and we're going to put this into this pair between USDC and ETH. Look at this, 6% on a monthly basis. That's 300 bucks. 300 bucks. 1 month later, we're at $5,300, right? Then we get that. Month number 2, and we're at $5,600, right? So we're actually going to be compounding this money on a monthly basis at 6%. Well, on a monthly basis, that's going to add up very quickly. But let's just do it simply here. We've got 12 months. We're earning 300 bucks, a little bit over 300 bucks, right? So that's 3,600 bucks. So now we're at 5,000, which is the initial amount, plus the 3,600 we burned throughout the year that we have not compounded, so it would actually be closer to probably $4 grand. It would probably be over $4 grand in all honesty. So we're going to say this is $9,000, which is that $4,000 plus the 5. And what does that generate you on a monthly basis? 5,000, right? 540 buckaroonies. What was your bill payment? 425 bucks. With this, you're using 100% of other people's money to pay your bill for getting brand new solar, brand new roof, brand new batteries, and insulation on your property. They're paying for it, because remember, that 5,000 bucks didn't come from my pocket. That came from their pocket. That came from their pocket. So I can use this to actually pay the bill. You're like, well, that could change. That is 100%. It could change. I actually made this even more conservative. You could use a more concentrated liquidity position, and you could earn a way higher return. If you concentrated your position here, so to something like this, where you are a little more concentrated, you're earning 775 bucks a month, right? In 2 months, you've got 3 months worth of the 425, or almost 4. right? In 3 months, you have about 5 or 6 months worth of payments already stacked up. This, remember, we didn't even take into consideration the tax savings that we can actually invest. Because imagine $53,000 worth of tax savings and taking this and investing that into, say, HEX for a year, or into liquidity providing per year, right? If we took the $53,000 and we put that into it, check this out, and let's make this more conservative and not say it's concentrated, right? So we're reducing impermanent loss, but it's not like a concern for, it's not an issue for impermanent loss, but $53,000. So say we take that $53,000 that we would have paid in taxes, instead of giving it to the government that will squander and waste and pay bribes, you take that $53,000, provide liquidity, and you make $2,500 a month. $2,500 a month. Every month you've paid 4 months worth of your, 5 months worth of your, almost 6 months worth of your utility bill. Every month you can pay 6 months worth of your utility bill. And remember, in this number, we didn't factor in year 2 of the interest write-off, right? So this is not just a single one-time tax event where you save money. You're saving money as long as you have this loan or paying interest on it. Now, we have covered a lot of stuff in this video. I'm going to give you a quick rundown of synopsis, and then I'm going to give you one more piece of alpha. You can effectively put solar, batteries, insulation, and a new roof, and HVAC, and a hot water tank, which I didn't talk about because I don't need those. Maybe I'll do the AC, but I don't really need the AC, right? So if this could increase how much cash back I get to put into investments, maybe I'll do it, but otherwise I don't think I will. Or if it can make the house more efficient so that I can increase the amount that I'm getting in net metering, then maybe I would, right? One of those two things, or a combination of either one of those things. You can put this in your house. If it's for businesses, it effectively can, say you're making $150,000 a year. $150,000, and say you're going to be paying 40 grand a year in federal taxes. You don't have to pay that, right? You wouldn't have to pay that, and then you would still have $13,000 left over, right? 40,000 minus 53,000 is $13,000. You could carry that $13,000 forward to the next year, add it to this write-off here, and then it reduces your taxes in year 2. Now, we took the money and we invested in the future so that actually can go through and pay a bill for us. So we don't ever actually have to pay a utility bill ever again. We use other people's money to do that. Now, what is this last piece of alpha? This is actually how I structure my business. So I'll get into that in just 1 second. Because if you appreciate it and you're still here at this point, then you're probably going to really like the business thing. But first, if you found value in this video, and you want to help me grow the channel and help a friend out that owns a house that likes this kind of stuff, take a second, there's a share button on your phone, press the share button, copy the link, and then send it to that friend and tell him, you should watch this crazy whack job. He's onto something here, maybe, right? This is what I'm doing, and I'll share this all with you as I move through the process. Now, if you want to check out Twitter, there's also a link down below. Appreciate a follow over there and interaction. A lot of these, a lot of ideas for videos come from the interactions on Twitter. So jump over there and give me your thoughts over there. Give a follow on Instagram as well. Link down below. If you like fitness-related stuff, if you also like fitness-related stuff, I have a weekly live Q&A podcast on my other YouTube channel. There should be a link coming up right at the end of the video on the screen, or it's in the description for the YouTube channel that's related to fitness stuff. So you can jump on at 6:30 p.m. EST on that channel and I'll answer questions, right, with a T expert, that's a testosterone expert, and sometimes we have guests on. So it's pretty cool. A lot of fun. Now, let's get into this business structure. I've got two businesses that are both held under my name. So what does that mean from a tax perspective? Remember, I'm not your accountant and all that jazz. Well, effectively, from my understanding, chatting with my accountant, I'm not able to net. I think I looked it up at the beginning of the year, right? So I have a tax loss carry forward from last year. I'm not able to net the losses in business one against the gains in business two because they're technically separate entities. So they only allow me to bring over, I think it's 50% of the losses in this business up to a maximum of like 50 grand against the profit over here. So what I'm doing so that I can actually utilize these tax benefits and they're not all stuck in this business is creating a holding company. That holding company is actually going to be like an investment holding company that's going to own both of those other two businesses. Now, I will not own those businesses from a legal standpoint. My holding company will own both of those businesses. That means that the gains from one company flow into the holding company, and the losses from the other company flow into the holding company, and the holding company nets those together and pays taxes on whatever's left over there. So hopefully that was a little bit of extra alpha there. Appreciate you guys. Don't forget to subscribe. Don't forget to press the bell notification. Talk to you soon. Peace. That was a pretty long video.